Okay, this is part 3 of Unit 4E, looking at income taxes. We just talked about Social Security and Medicare taxes, also known as the FICA taxes, right here. So we are going to, in number 47, look at this individual, calculate the FICA taxes and income taxes to obtain the total tax owed. And then we're going to find the overall tax rate on the gross income, including both FICA and income taxes. And we're going to assume this person is single, taking a standard deduction. So there's quite a bit involved in this question, but we'll roll right through this. So the first thing we're going to find is how much is owed on the FICA taxes. So for the FICA taxes, remember it was 7.65% of the income, or the earnings, I should say. So you take 0.0765 times it by 44,800. Because FICA does not apply to your interest, and we'd get about $3,427.20, and that is your FICA taxes. Okay, next we need to find the taxable income before we can calculate the taxes. So the taxable income is our adjusted gross income. So that's found by doing 44,800 plus 1,250, because those earnings and interest. And we don't have any adjustments there because we just have the interest and the salary. But then we are going to minus the individual or the single exemption of $4,050 and the standard deduction of $6,350. Again, that comes from this table up here. Okay, so here's your standard deduct, or your exemption and standard deduction, since the person is single. So we have a taxable income now. This is equal to, if you subtract all of that, $35,650. So there's our taxable income. So to find out our taxes that we have to pay based off our marginal tax table, we're going to take first 10% of, again, your first $9,325, plus then we move up to the next margin, which is 15%, and that goes up to $37,950, I believe. And we don't quite, our taxable income isn't quite there, so we're going to be in the 15% tax bracket. So we would take $35,650 and minus $9,325 again, because that's the portion that's taxed at 15%. And so when we do out all of these calculations right here, we get $4,881.25, and that is how much we owe in taxes. So that's kind of another key number there. So the total tax, so we'll say total tax here, is the FICA tax, $3,427.20, plus the income tax, $4,881.25, and we get a total of $8,308.45, and that is the total tax that is owed during that calendar year for Jack. And that, it says 83. It doesn't look much like a 3. So then we want to find out what portion of Jack's earnings and his gross income, what portion of that is paid out to taxes. So what we do is we take the amount that he's taxed, 8308.45. We divide it by that total, which is take the 44,800 and add the 1250 in there. So this is $8,308.45 divided by, when I add those two numbers, I get 4650, and that's about 0.18 or 18%. So for Jack, 18% of his gross income goes to taxes in this given year, based off of the parameters of 2017 that we have. So again, that's just a look at finding the FICA taxes, then finding the taxable income, and then calculating the income taxes, the total tax, and what percentage. Okay, the last problem we're going to look at, this one's got a lot riding here, or a lot going on here. So we've got the situation where you have a couple who is engaged to be married. We're going to calculate their income tax in two ways. One, if they were to delay their marriage until the next year so they can file taxes as individuals at the single tax rate this current year, 2017, that we're looking at. And then we're going to compare that to two, if they marry before the end of the year and they file a joint return. Okay, we're going to assume that each person takes one exemption, so $4,050 per person, and they each take the standard deduction. We're going to use the tax rates in 4.9 now and find out if the couple faces a marriage penalty if they marry before the end of the year. And married rates apply for the entire year regardless of when the marriage took place. So if you get married on January 1st or December 31st, and you'll be able to file jointly in either scenario, and it's as if you were married for the entire duration of the year, no matter where it falls in between. So we've got adjusted gross incomes for Gabriela and Roberto. And so again, if with adjusted gross income, we've got to find the taxable income. So first we are going to do Gabriela at $94,400, and we have to minus off the exemption of $4,050 minus the $6,350 for the standard deduction, and we get $86,000 is so that's the taxable income for Gabriela. So to find out how much she owes in taxes, we're going to take 10% of the $93.25 and then go up to the next bracket, and she's well above this bracket, which is $37,950, and then minus the, again, $93.25. And then the next bracket, if we look at the next bracket, again coming way up here, the next bracket in the singles is at $91,900, and so the $86,000 falls below that, so she's in the 25% bracket. We take $86,000 because that's as high as she went, minus the lower threshold of the 15%, which is $37,950. Let's see. And if you multiply all that out and then add it together, we get, let's see, where did we go here? $17,238.75. Okay, and that would be for Gabriela. Now we're going to look at Roberto. So Roberto, he's got $82,600 in income minus the exemption minus the standard deduction. So for him, we get $72,200 is his taxable income. So we're going to follow all the same process here. So 10% of $93.25 plus 50% of, so he's above the 15% bracket, so he gets the full charge on the 15% range. But then we do 25% this time of $72,200 minus that lower threshold, $37,950. And for Roberto, we get that he owed $13,000. $788.75. So if we combine their taxes when they're single, the total tax here is going to be, we take the $17,238.75 plus $13,788.75, and their tax burden for that year is $31,027.50, which would be rounded to $31,028. But that would be the total tax paid for their incomes when they file singly. Now, when they're married, then things change up a little bit. First, we're going to find they're married and filing jointly. So we need to find their taxable income when they're filing jointly. So we first got to add up their two adjusted gross income, so $96,400 plus $82,600, which gives us $179,000. So that is their adjusted gross income. Then we assume that they take the exemptions, one for each of them. So we subtract 40/50, subtract that twice, one for each individual, and then we subtract the standard deduction for a couple that's married filing jointly, and this will give us a taxable income of $158,200. So here's our taxable income. I'm running out of time, so we're going to have to just kind of hurry through this last part. So for married filing jointly, the 10% margin is 10% of $18,650. So they're definitely above that. So then the next one is 15%, which is $75,900, and then minus $18,650 because they're taxed 15% on that range between $75,900 and $18,650. But they're above $75,900, so we go up to the next bracket, which is $153,100, and they're still above that. So we take $153,100 minus $75,900. We actually have to go up to the 28% bracket. So the 28%, so it'd be 28 times. I'm going to have to write this down below here. And their peak is, or their number is $158,200 because that's how much they make. The threshold for the 28% goes well above that, but they only made $158,200, and then we minus that lower threshold, $153,100. So again, add and subtract there, and then multiply everything out, sum, and do all that good stuff in there. And you're going to get a tax burden of $31,880.50. So if we compare the two, they actually have a tax penalty, or a marriage penalty. Oops. Because notice when they were filing as singles, it was $31,027.50. Here it's $31,880. So they had to pay more money in taxes when they were married, and so there was what we call a marriage penalty. They ended up paying more money when they were married. So that's a look at Unit 4E, income taxes. If you have any questions, please do not hesitate to let me know, and I hope this helps out and that you have a great day.